Gentlemen, welcome. You know, there's been anxiety, I suppose, Ron, about the pace of income growth that was revealed in this morning's numbers. But income growth is usually a pretty good thing, isn't it?
Yeah, you know, Tyler, I'm tiring of some of the concerns that people have about wage growth, particularly with inflation coming down and crossing through that wage number that we saw. Inflation is beginning to fall below the increase in wages. So you're not looking at a wage price spiral if the two are not going up in tandem. And with a little more buying power and savings having been bought down rather dramatically, the savings rate now is at pre-pandemic lows. I'm not so sure why everybody's getting entirely concerned about this. And the Fed's got almost a Vietnam approach to this. They're going to destroy the village to save it by driving up the unemployment rate to get slack where we have no people. It's not that the labor market is so tight because the economy is overheating. Jay Powell himself said it this week. We are short human beings. Raising rates won't solve that.
You know, it's interesting, Michael, because I'm very closely watching what's happening in Las Vegas and the spending that's happening there. And they're just printing money on the Strip. They're pacing 20% of all of 2021 by the end of October. When you look at that, I don't know, you got to ask, are rumors of the economic demise greatly exaggerated?
Yes and no. The consumer has been sort of revenge spending. You've heard about revenge travel, sort of pent up from the great pandemic. There's sort of revenge spending now, too, I think. And people are feeling better about these increases in their paycheck. Even if those increases in the paychecks aren't keeping up with the increases in prices at the store, they can't afford as much, they still feel better. Consumer sentiment is hugely important. How the buyer feels is hugely important. In an economy that's two-thirds driven by the consumer, it's really important to see if they have any money. Ron mentioned the savings rate. It's come from 9.3% to 3.1%. And the credit card balances are really on the rise. So the consumer is running out of wallet, even though the consumer isn't running out of attitude. At some point, the attitude runs into the inelasticity of wallet. I don't know if we're going to get there soon, but it's coming. In the meantime, spending is still on and the mood is still ebullient.
So, Ron, when you're looking at the companies in this case, we just had a report from Houston about the pullback in bonuses on Wall Street from the big banks. You look at the way that a lot of the tech companies are paring down and doing some cost cutting. It seems like they're taking, companies in the United States are taking much more seriously the threat of economic recession than consumers and their revenge spending, so to speak. How closely are you watching how that may kick us into recession?
Well, I wouldn't necessarily say that Wall Street and Silicon Valley will kick us into recession, Contessa, so much as...
But ad spending, you know, in media, ad spending is way down.
Sure. Yeah, no, listen, I'm entirely worried that next year we have a recession. If you look at the slope of the yield curve, which is fully inverted now by every measure, Arturo Estrella, the gentleman who did all the seminal work on this at the New York Federal Reserve, points out that now that we've had a full month inversion, we are somewhere between 6 and 17 months away from a recession. Since 1968, when we've seen this kind of inversion, there's been a recession 100% of the time afterwards, again, somewhere during that period of 6 to 17 months. So it takes time, you know, and I don't necessarily believe that Fed policy works with this considerable lag. We've got a big recession in real estate already. And again, as Michael indicated, you know, the consumer's a little overextended at this juncture and may run out of gas sometime relatively soon. And again, bonuses are being cut on Wall Street and Silicon Valley is laying people off. You know, it's a matter of time before it happens. And again, I think the Fed is probably going to go too far in all of this by the time all is said and done.